Are you a business owner thinking about retirement? Do you know the best way to withdraw money from your corporation or holding company? I'm Maxime Dubé, Portfolio Manager at Claret. In this video, I'll explain some key principles to efficiently withdraw money from a holding company and reduce your taxes during retirement, and more specifically, how the capital dividend account works. Assuming you've earned enough money through your business to retire, how can you get money out of your holding company and minimize taxes? One of the common ways is through capital dividends via the capital dividend account, commonly called the CDA. The capital dividend account is a fictional account whose balance increases when a company makes gains such as capital gains on stocks and other types of securities, gains recorded on the sale of certain fixed assets, capital dividends received from another company, or proceeds received from a life insurance policy taken out by the company. Since only half of capital gains are taxable, when a corporation makes a capital gain, the untaxed portion of the gain increases its CDA balance, which means it can be paid out to shareholders tax-free. On the other hand, when a company records a capital loss, the untaxed half of the loss reduces the CDA balance. Let's look at an example. Sarah has accumulated $500,000 in various investments within her holding company, such as stocks, bonds, and mutual funds. She also owns a rental property with a market value of $500,000. On top of that, she has an RRSP and a TFSA, but she mainly wants to use the funds from her company to finance her retirement. She consults with her accountant and portfolio manager for advice on how to effectively withdraw money from her company. To be able to consider paying herself a capital dividend, Sarah must first be able to realize a gain, that is, sell one or more assets at a profit. If the cost of her building is $250,000 and she sells it for $500,000, she realizes a capital gain of $250,000, of which only half is taxable, so $125,000 at the corporate tax rate. The amount equivalent to the non-taxable portion, also $125,000, will therefore increase the CDA's balance by the same amount and can be paid to her tax-free. The logic is the same if she decides to use her stocks, bonds, or mutual funds to trigger capital gains, provided she has unrealized gains. In other words, investments that have increased in value but have not yet been sold. This does not mean selling all the investments that are profitable. It is possible to crystallize the gains, that is to say, to change the book cost to the current price and realize the gains for tax purposes. Thus, the gains are realized and you can keep any investments you like. Capital dividends can be an effective technique for taking money out of a company during retirement. By using these dividends as a source of income, you can finance your personal expenses with assets accumulated in a company. Since tax laws are always evolving, many suggest using this strategy to diversify the risk in case governments decide to change the rules of the game. This is even more true for those whose assets are mainly concentrated in a single tax structure, such as the holding company. Several factors can influence a good disbursement strategy, and it is important to consult an accountant as well as a portfolio manager for personalized advice. For more investment ideas, visit our website at claret.ca or contact me directly by clicking on the link in the description. And don't forget to click on the subscribe button below.